Hi all, hope you're doing well. Welcome to our channel India Equity Investing. And today we are going to talk about some of the key portfolio updates at our end, wherein we are, looking to offload our stake in a staggered manner in DB Corp and build up our existing position in SH Kelkar. We will first start by talking about DB Corp in terms of what our rationale was for investing in the company, what the current scenario is, and why we are exiting the company as of now. And then we'll talk about SH Kelkar briefly in terms of why we are looking to increase our holding in the company. We first started looking at DB Corp during the onset of COVID, that is around Feb of 2020, when people started becoming hesitant to buy newspapers and the newspaper circulation started to decline. So effectively, when people were not buying newspapers, that's this time we started looking at newspapers. So at that point in time, what happened was that the industry was likely to face significant challenges in the near term on two fronts, basically. The circulation started to decline, and the advertising spend, which is basically a discretionary spend, that started to go down at the same time. So this created a situation where the two leading print media companies, which are Jagran Prakashan and DB Corp, both of them started to trade at depressed earnings multiples of around 7 to 8 times trailing earnings. In case of Jagran, it was further depressed as well. And these depressed earnings were 50% below the normalized earnings of the companies. So effectively, if you think of it, the companies were trading around five odd times their normalized earnings, even less than that. And one beautiful point about such media companies is that they generate a lot of cash. So DB was just throwing up cash, and they had capacity to face such headwinds, and in other words, a capacity to bleed for some time if required before the things started to turn around. Our primary rationale for investing in this company was that over a period of time, the mean reversion in earnings as well as trading multiples will take place. So our bet was basically two-pronged, in which we were saying that yes, the earnings of the company that are likely to that we are likely to witness over the next few quarters will not represent the normalized earnings, and it will take some times before those earnings tend to come back. And we believe the reversion in earnings will take place, and when that happens, we also believed that the earnings multiples will also normalize. And so what the market was looking at was that there was very high uncertainty in terms of when the mean reversion will take place, but at the same time the probability of reversion happening at some point in time was very higher. So if you think of what I'm saying over here, is that we did not know when the mean reversion will take place, but the probability of that happening was always very high. And what happens in the markets is that markets hate uncertainties. They completely dislike them, and whenever uncertainties come into the picture, the stock prices tend to go down significantly. And these kind of situations n- can offer a potential investment opportunity at that point in time. So we were expecting the newspaper industry to bounce back strongly last year. But what happened is that once the situation started to normalize, the newsprint prices started to increase significantly. So much so that for DB Corp, the newsprint prices increased by 40% during FY23 on a YY basis. But what has happened now is that starting of FY24, now the company is seeing strong tailwinds on three fronts, basically, which are increasing circulation, increasing ad spend, and also newspaper prices going down. And these factors combined with upcoming general elections, will provide a good opportunity for print media industry to show impressive earnings growth. So, if we look at the latest quarterly performance of the company reported a revenue of over 550 crores, which was a 12% YY growth. and the gross profit margin increased by over 500 basis points because the newsprint prices have started to decline. And this resulted in an EBIT of close to 21% and a PAT of around 80 crores. So if you look at the company's performance since first quarter of 20, it was only during after COVID. If you look at third quarter of FY21 and third quarter of FY22, which is normally the strongest quarter for the print media companies due to festive season, the company's performance during first quarter has been absolutely fantastic, and this has resulted in a EPS of around 4.4 for the first quarter. Now, carefully looking at the FY24 expected performance of the company, we expect revenue to be in the range of around 2400 crores with an annual revenue growth of around 13%. We expect marginal increase in gross profit as compared to Q1 and marginal increase in EBITDA to the extent of 22 odd percent EBITDA margin for FY24, resulting in a PAT of around 311 odd crores, which results in a fully diluted EPS of around 17.5. So for FY24, we expect the EPS to close to double as compared to that of FY23. After that, for FY25, we have built a base case assuming only a 5% revenue growth. The probability is that the revenue growth is likely to be higher than this, but we have taken a base case scenario and we expect EPS to be around 19 rupees for FY. These are the key cost items for the company. So let's look at the newsprint prices, which earlier used to hover around 35 or 1000 rupees per ton, which in FY22 was at 44 or 1000 rupees per ton and reached close to 62,000 rupees per ton. For this year, we expect this number to be in the range of 56 or 1000 rupees per ton. And this is likely to result in significant cost savings. And overall, if you look at it, the return parameters are very impressive for the company. Here is the balance sheet of the company, and so we can see this out of 2000 odd crores of shareholder funds that exist in the company. We expect the company to have cash in the range of 840 odd crores, including financial instruments as well as the cash and bank balances. So it's a pretty tight ship that they are running, and you can see that for a 1300 odd crores of shareholders equity, they are able to generate a PAT of over 300 crores, which is quite sustainable in nature. So here are the key balance sheet ratios for the company. We have not changed these parameters significantly and largely expect them to trend going forward at the same rate. You can pause and have a look at these ratios in case you want to understand these better. So here we look at the cash flow statement, and this basically reflects the reason why we like print media companies in their bad times, because just see that these companies generate such huge amount of cash and there is no significant investment that they need to do, uh, including reinvestment, in order to sustain those earnings and cash flows, and hence bulk of this comes out in terms of equity buyback or dividends. So this reflects the inherent strength in the company and this kind of business. And one challenge that the print media companies are facing, which is quite ubiquitous, is that the earnings growth and the circulation growth is not expected to be uh, very good over the next decade or so. And I think if we can discount that factor in the pricing when we buy such stocks, I think there is always a good opportunity to invest in such companies. Here we can look at the trailing 12 months P multiple chart of DB Corp over the past 13 and a half odd years. And if we see the company's earning multiple today are around the highest uh, range in which they have traded over the past 13 odd years. And we expect these to normalize a little bit because if you assume a FY 24 EPS of around 17, then on those bases, the company is trading somewhere around 13, 14 times FY24 earnings, and hence presents an opportunity for increasing prices. Because I think for companies like this, assuming a kind of a 17 to 18 times multiple over the next 1 year is the kind of likelihood with which we have built our exit. So now we look at our investment, how it has performed, and also the current ROI potential that exists in DB Corp as of today. So we built our positions in DB Corp over a 18 month period starting Feb 2020. So at that time, the near-term outlook was of high pessimism and high uncertainty. So our average purchase price came in at a little under 79 rupees, and we have started partially offloading our positions today at the price of 247 per share. And including dividend payout during this period, we have generated an IRR of around 55% during the weighted average duration of around 2.6 years. So, we are now looking to exit our entire position over the next 2 to 3 quarters when earnings are likely to increase. So, the period that you're getting now in near term is that of optimism and certainty. And we hope to, exit during this period. So, if you look at the valuations as of today, assuming a current price of, taking the current price of around 230 rupees with a market cap of around 4,000 crores. We expect the company to trade over the next couple of years in the range of 17 to 18 times its trailing 12-month earnings. And that still provides an IRR opportunity of around 22 to 25%. Now, this is something, which is not something which excites us. And we believe there are other investment opportunities that exist or are likely to come up over the next few months. So we would like to, now create more, gunpowder in our portfolio so that we can take benefit of the right opportunity as and when it comes across. Now, I will very briefly touch base on the reason why we are looking to increase our holdings in SH Kelkar and talk about the current ROI potential that exists in the company. So, in order to understand our views about SH Kelkar, we would suggest you to refer to our detailed presentation on the company that was published before fourth quarter FY23 results came out. And during this year, we expect the company to achieve a revenue growth in the range of 11 odd percent with around 14% EBITDA margin. Now, considering that FY23 was not a great year for the company, this is likely to result in a PAT for FY24 in the range of 120 odd crores as compared to a last year PAT of around 63 crores. Now, the probability of achieving the expected revenue growth and earnings estimates will be, clear after the Q1 results come out. And it is likely that our estimates may change after the results are out. And we will be publishing a detailed update on the company as well as the business fundamentals next week once the results are out. And, given the stock prices as of today and our basic assumptions for an investment horizon of around 2 to 3 years, we expect to achieve an IRR in the range of 35% over the next 3 years. So here we see the P&L statement for the company, wherein we are showing a 11 odd percent revenue growth and a EBITDA margin in the range of 14 odd percent and EPS in the range of 8.6. So we see a significant delta as compared to FY23, and then we expect over the next 2 years from FY23 EPS of around 4.55 or a normalized EPS of around 5. This is expected to reach around rupees 13 by FY26. Here we can look at the key cost items of the company and the return ratios that exist as of today. So 11 odd percent is the ROE we are expecting for FY24. Not great, but we expect this to improve going forward. The company has done a lot of acquisitions, and there are a lot of tie-ups that the company is doing. So we expect these to translate into better ROEs going forward until as the company gets into an acquisition spree, the probability of which, at least in the next 1 to 2 years, seems quite low. So here we can have a look at the balance sheet of the company. Our comments for the balance sheet remain the same as shared earlier. Here are the key balance sheet ratios that you can look at. So our comments for the cash flow statement also largely remain the same, where we expect a good amount of cash generation happening for the company. So after the amount has been paid for acquisitions, we expect some debt repayment to kick in. And then I think in next 1 to 2 years, we can expect cash generation to be either shared with the shareholders or to be used for further acquisitions by the company. As of today, the company is trading at 14 times its FY24 expected earnings, which I think shows a depressed multiple for the company. Historically, the company has traded at much higher multiples, and given the current scenario, we do expect that the company can trade in the range of 22 to 25 times trailing multiple over the next 24 to 36 months. So, looking at the current market cap of around 1600 crores, we expect this to reach somewhere between 4 to 4,500 crores over the next 34 odd month period. That is once the FY26 results come out. And this presents an opportunity to generate between 37 to 42% IRR over this time horizon. If you look at a lot of companies in similar spaces trading as of today, the multiples are significantly higher. So assuming the exit multiple of around 25 odd times is kind of a fair assumption, and we are not building a lot of optimism in the exit multiple for the company. Here we can look at the trailing 12-month earnings multiple chart for the company since its listing, and we can see that the multiple has gradually come down, and currently it is trading on FY23 earnings in this range, which I think should come down around here for FY24, and hence also presents a good opportunity for price increase to take place. Given the current scenario where a lot of things have run up significantly, much beyond the fundamentals as well over the past 3 odd months, we believe SH Kelkar is still relatively better price and provides a better opportunity for good ROI generation. So with this, we end our presentation. I hope you found it to be informative. Please feel free to share your views if any. Thank you for your time once again, and we look forward to sharing our views with you going forward as well.